Hey guys, it's Ryan here with the Investor's Edge. And today what I want to talk about is 100% financing. One of the things in real estate that it allows you to do is this principle called leverage. Leverage can be fantastic, and if misused, can really get you in trouble. So we want to talk about good leverage versus bad leverage and how you can use that in real estate investing. One of the ways that you can do that is by getting what's called 100% financing. And this really comes down to 100% of what? So we're going to jump over to the whiteboard here so we can talk about this for a minute. So here's the thing. When you do a property, a fix and flip, a BRRRR, any of that type of thing, you basically are going to have a purchase cost. Okay? That is going to be how much you're paying to buy the property. We'll just call it $150,000, just to keep some simple numbers here. Then you are going to have some closing costs. There's going to be title fees, there's going to be insurance, there's going to be legal fees, there's going to be all kinds of stuff. We'll just say $4,000 on there. Could be more, could be less. Just this is not about what the numbers are, it's about the principle of this. So the closing fees. Then you're going to have some loan fees, like a loan origination. Say that's $5,000. And then you've got what's called the rehab. The rehab amount, how much work is going to get done? Let's call it $25,000. Again, just using simple numbers. Now, that is going to equal how much we're going to say is into the investment. So this is our all-in cost. So to do that, I should be able to do this in my head, but I always refer to the calculator because I want to make sure I don't make a mistake. So 150 plus 4 plus 5 plus 25 equals 184. 184,000 is our all-in costs. However, one of the things that a lot of people forget about is payments. You're going to have monthly payments on this amount at whatever interest rates agreed to. Let's just say it's a 14% rate. Could be more, could be less, but that's 184 times 14, just for rough math, divided by 12 is going to give us, divided by 12, $2,146. 460. Okay. Now, most lenders require you to make monthly payments. So you're going to make this payment every single month. And let's say it's going to take you 6 to 8 months. If we take that with my handy dandy iPhone calculator, let's just say 8 months, that's $17,173 that you'd have to come in with payments. Now, this is where it gets really important. So follow me on this. Most lenders, if we're talking about a fix and flip or a BRRRR, which we can talk about both of those, actually, I should probably say a fix and flip is where you buy the property, you fix it up, resell it for a profit. Okay. A BRRRR is where you buy the property, you rehab or renovate the property, you rent the property with your lender's permission, with those monthly payments going to your lender to pay down your loan, and then you refinance the property. And the great thing about this is it's easier to get a refinance because the property value has gone up. Because in this type of a deal, this property value has got to be worth $225,000 or something like that. And then you can refinance and have little to no money into it. This is a way that people get into rental real estate really easy with great returns. So that's either way you look at that. Now, a lot of lenders, and we're going to talk a lot about lenders, are going to require 20% down. But that 20% down is only applying to the $150,000, so that'd be $30,000. In addition to that, they want you to pay the closing costs. They're going to want you to pay the loan fees. They're going to want you to pay for the rehab, and they're going to want you to make monthly payments. So then when you talk about this and say, holy cow, this is actually a lot of money, Ryan. Yeah. But most lenders are just going to say, oh, you got to put 20% down. But then when you start looking into it, you're saying, oh no, this is a lot more money than I thought. Whoops, 5,000 plus 25 plus 17,173. So now you're $81,000. Okay. Almost 82,000, let's call it. So you're $81,000. Well, if you look at that 81 against 150, that's really like you're putting 50% down, right? Now, there are some lenders that are going to say, you know what? We want you to pay 20% of the purchase and the rehab, okay? So that's $175,000, and they want you to pay 20% of that. So that's going to lower the cash to close. So if you say 175 times 0.20, that's going to be $35,000. $35,000, but you're also going to have the closing costs. You're also going to have the loan fees, and the rehab's already included in that cost, but you're also going to have monthly payments. So when it really comes down to it, your 35 plus 4 plus 5 plus 17, you're going to be at $62,000. Okay. So the problem is, what if you don't have $62,000? What do you do? How do you get into the game? How do you make something happen? Well, that was a problem that I ran into. So I want to talk to you about the spectrum of lending so you can understand the difference between the lenders and what's out there and what can be done. So let's clean off this whiteboard real quick. Okay, so this is what I'm going to call the lending spectrum. Okay, over here, we're going to have what are called traditional loans. Over here, we're going to have what are called hard money loans. Okay, let me give you the extreme differences on both of these so that you can understand that, and then we'll start talking about some of the spectrums here. Okay, so when we're talking about a traditional loan, okay, most of the time you're going to anywhere from 5 to 20% down. If it's a homeowner loan, you're probably 3%. They want good credit scores, those types of things. They want to your job history. They want to know if your future employment looks good. They're going to want to know everything about you. Let me actually just pull up some of the requirements for traditional loans. They're going to want to make sure your LTV is good. They're going to want to make sure you can get what's called mortgage insurance. And I'm going to talk more about this mortgage insurance in just a moment. Credit score has got to be 680 plus, typically around 700. Good steady income, mortgage insurance, no, can't have any bankruptcies. They're going to want to make sure debt to income is a certain level, which basically the idea is for how much money you bring in to how much money you go out, they don't want you to be spending more than 43% of your income on debt. And if you are, they're going to deny the loan. So those are some of the things that these traditional lenders are looking at. So these traditional lenders are basically saying, we're going to qualify based upon the person primarily, not based upon the property. Now, they still want to make sure that it appraises and, all that type of stuff. That's going to happen. Now, let's get over here to this other side of the spectrum, which is hard money loans. Hard money doesn't mean it's hard to get. It's actually easy to get, because what hard money lenders are lending on is they're lending on the asset. Okay? They're basically saying, we're going to lend on the asset, and if that asset has enough equity and we can make money and recover no matter what, then that's a good deal for us. So if they're lending on the asset, that's what they're looking at. And that's why it's called hard, because they're lending on the hard assets, where in traditional, they're lending on what we call the soft, which is the borrower's information, ability to repay, all of those things is included in this side. Now, we talked about this example about the money that needs to come to buy one of these investment properties. There are on the spectrum here, you've got some that are closer to traditional loans, and you've got some that are closer to more hard money loans. Each one of these are different types of lenders or lender programs, and depending upon where they fall, I don't care what they call themselves. Traditional lenders, we're saying like Wells Fargo, Chase, Bank of America, Credit Union, whatever the case is. Hard money lenders is like strictly lending on the asset, don't care about anything else. That's where you're at. You're going to have a spectrum here. Some of them may call themselves a hard money lender, but if they're requiring your debt to income and credit scores and all that type of stuff, they're really closer to this traditional lending than they are to hard money lending. So if we want to do deals with leverage, What we have to do is find lenders that are willing to do that. So if I don't want to make payments, let's get a different color here. Let's say I want to wrap in my payments. I want to wrap in the loan. Okay, so, and let's say I don't want to worry about debt to income. And let's say I don't want to put a bunch of money down. And let's say I don't have great credit scores, but I don't have bankruptcies and those things. Mortgage insurance, no mortgage insurance. Mortgage insurance basically pays the lender if they suffer a loss on this loan. You're paying it each month. That goes into a pool. If they suffer greater than a certain loss, then the bank gets paid back from the mortgage insurance company. So really, this is a no-lose situation for the bank as we're talking about volume. They could lose on one property, but they're not going to lose on the portfolio because they've got mortgage insurance that's going to take care of that. So they're really there's not a way for the bank to lose in this. That's an overgeneralization, but just so you understand it. Now this side, there is no mortgage insurance. There is no debt to income. They don't care about job history. They don't care about future employment, all that type of stuff. So the only thing that they have to go off to protect their investment, because remember, this is somebody's money, is the property itself. So we'll just call that the home, okay? So the closer to the hard money you're getting, the more money the lender is putting in. The more you come down to the traditional loans, the less money that the lender is actually putting in. So if you want to get a loan that is going to cover most, if you want to get a loan that's going to cover most, if not all of your cost, you are talking about somewhere in this range, which means they're more concerned about the asset. On this one, they're more concerned about the person, right? More concerned about the person, more concerned about the asset. Each step you go is going to be in there. Now, there are some people, let's walk through some scenarios here. Yeah, let's use red. Okay, we're here, and we're here. We're just going to call this hard money, and we're going to call this traditional. Okay, this is about the person. This is more about the asset. And there's a middle ground somewhere in here. So let's say that you want someone to cover the purchase, the rehab, the closing costs, lender fees. Okay, let's say you want somebody who can do that. In our other example, we'll just use some raw numbers, 100, 50, 10, and 10, just to make it easy for math. It's $170,000, okay? They're into this deal $170,000, okay? This is more of an asset-based loan, right? Because if they don't care about the person as much, credit scores, propensity to repay, job history, all those different types of things, then they have to lean on the asset. So this needs to be a better asset deal than what a bank would be willing to lend on, because the bank is going to be getting all those other things with mortgage insurance and history and loan to value and debt to income and all those different types of things are coming in here. So they take on very little risk because they've got that mortgage insurance that's going to pay them off. In this scenario, the lender's taking on quite a bit more risk, because if you think about it, you're buying the property for $100,000 and they're lending you $170,000, okay? Let me say that again. You're borrowing $170,000 is what the lender's putting in, and you're buying the property for $100,000. So you're getting $70,000 more to do these types of things. Well, to do that, the asset gets looked at quite considerably. Is the value there? Is it gonna make it? Is that going to happen? Those are all things that are going to get looked at. Now, as you come down here, let's just talk about maybe some hard money lenders where they're saying, hey, we want you to do 20% of the purchase, and you pay for everything else, which was like $81,000. Okay, that's probably somewhere in here. They're not on the traditional side, they're on the hard money side, but they're getting pretty close to that. Or you could say, hey, we'll do 20%, and you've got to 20% of the purchase of the rehab, you've got to cover the rest of it. So the closer that the more money that you're asking for, the more you're getting towards the asset side if you're not putting up your credit and all those different types of things. Now, if you have great credit and you've got money down, you've got all of that, you're going to be coming more towards the traditional side rather than the hard money side, which is an asset-based loan. This is what's important and what I want you to remember from all of this. The closer to here you get, the more concerned they are with the asset. The closer to here you get, the more they're concerned about the individual, about the person, okay? That's what's really important here, is that you understand that. So the closer you get to here, the more expensive it is. Your interest rate's gonna be higher, your origination is gonna be higher, your fees are gonna be higher. This is gonna be the most expensive loan because it is dealing with a lot of risk, and it does not, and they're putting in a lot of money, probably even more money than what they're purchasing the property for. On this, it's going to be low rates. You know, right? This is going to be the 6% interest rate you see going down the freeway, and lower costs on origination fees and all that type of stuff. Well, why is that? It's because the traditional lender with mortgage insurance, with propensity to repay, with a great credit scores, with money down, all that type of stuff, has a very, very low chance of losing money. Okay, where on this other side, the hard money lender is taking on an enormous amount of risk and could potentially lose an enormous amount of money because they're typically valuing this property based upon what's called the ARV, which is after repaired value. Okay, there's as is value, or there's after repaired value. If they're using the after repaired value, then they're lending on this asset as to what it's going to become and not what it is today. That's really important. And so anytime you come here, it's going to cost more as you incrementally go up. Now, let's say you've got great credit and you've got money down, you've got that type of stuff. Well, you're going to be somewhere more in this range, right? So it's not going to be as expensive as this, but it's certainly not going to be as cheap as that. So you're going to land somewhere in this spectrum with your personal qualifications and the property qualifications. Now, can you get a loan just based upon the property? Yes, you can. But there aren't a lot of lenders that will do that. If you're in the middle of a bankruptcy, I don't think you'll find a lender to do that. I haven't seen one. If you're in a bankruptcy or you've had a recent foreclosure, those types of things, if you've got collections or judgments, because those things could attach to the property, if you've got those things, most lenders aren't going to want to talk to you about that. Now, what has to happen on this spectrum for you to be able to do it? Over here, it has to be a great deal. Okay, this type of deal, if you're going to be into it $175,000, it's got to be worth $225,000. You've got to have a lot of equity. You're buying this for $100,000 and it's worth $225,000. You have got to be getting a great deal the closer you're getting to this hard money. The further you're getting over to this traditional money, not as good of a deal, right? You don't have to get as good as a deal. All they want to make sure is that the appraisal equals what the loan amount is. As long as the appraisal equals the loan amount, done deal. Do they care about the property? Yes. They want to make sure it's in good condition, all those types of things. And that's one thing most people don't realize is banks won't lend on properties that are in need of work. They want to lend on properties that are move-in ready condition. You can actually live in there. So if it needs work, it's not going to qualify for that. You're going to have to get more of the hard money side of that. Over here is more risk. Over here is less risk. Over here is based upon the property. Over here is based upon the individual. Okay. And there's the spectrum that's in this. More expensive, less expensive. Asset based, person based. So let's talk a little bit about this concept of 100% financing. Okay. So let's say $100,000 purchase. Let's do the rehab is $25,000. And then let's say that the lender fees are $5,000, and we're going to say that the title and closing costs and all that type of garbage is another $5,000. I shouldn't say garbage; it serves a purpose. And so that's what you're going to be into it, which what is $135,000. However, you're also going to have your monthly payments. Let's just say it's $2,000 a month, even though I know it's not. We'll times that by 8 months, and we're about $16,000, depending upon what the interest rate actually is. Now, remember, the closer to the hard money, the higher that interest rate. The closer to the traditional, the lower the interest rate. So based upon what you have. Now, when I got started, I didn't have bad credit, but I didn't have good credit, and I certainly didn't have enough money to put 20% down. Let's do a different color on this so we can make sure we're all on the same page here. I certainly didn't have enough money to put 20% down. So that'd be $20,000, plus pay for the rehab, plus pay for the lending costs, plus pay for the closing costs, plus pay for my payments, right? That's 20, what is that, 25, 50, let's just add it up. Okay, so we've got 20 plus 25 plus 5 plus 5 plus 16. Okay, that's $71,000 that I'd have to come up with to do this property. Well, I didn't have the $71,000. Okay, so what I had to do is I had to get a deal good enough where the hard money lender would be excited about funding all of this for me, okay? Where the hard money lender would say, you know what? We are gonna do 135 plus 16. We will do plus, we're gonna fund $151,000 on this project, okay? So why would a hard money lender wanna do that? Because they think the property is worth significantly more than that. So if something happened, let's say the property is worth $125,000 or 125, 225. Okay. So the hard money lender is saying, hey, if you get a good enough deal where your purchase, your rehab, your closing cost, your lender fees, and your monthly payments are, let's just say 75% or less than what the property is actually worth, then we would be interested in funding all of that for you. Now remember, they're taking on, the majority of the risk is here. They're taking on a lot of risk to do that. It's gonna be a more expensive loan, right? But you're using leverage to do this. So if it's 135 plus 16, let's see, 135 plus 16, 151 divided by 0.70. So 215,000, okay? $215,000. So this property has to be worth $215,000 is what this property is going to need to be worth once all the renovations and everything's done to it. Okay, here's a little smokestack and looks great. Well, keep in mind your resale price is $215,000. Your purchase price is about $100,000. So you're really getting this for about 50% of the ARV, after repaired value. What percentage it is of the as-is value depends on the property. Now, if you're doing that and you want the lender to fund all of that, there are lenders that will do that. However, it's got to be what we call a really good deal. Actually, we should say a really, really good deal. Not just a good deal, a really, really good deal, because you need to make sure that what you're buying it for, selling it for, that all of this, all these costs are 75% or less of the after repaired value of the property. Now, what's important with this is, how do we determine that after repaired value on the property? Well, we're talking about a hard money lender. We're talking about an asset-based lender. So they're going to spend time. They're going to look at comps. They're going to want to make sure it looks good. They're going to want to make sure that there's not concerns with that. If there's houses that are selling for a lot less than $215,000, they're going to say, wait a minute, the house across the street just sold for $150,000. The house around the corner sold for $175,000. There's no way we're going to get $250,000. They're going to want to see that there's 3 to 6 comparables within a 1 mile radius, the closer the better, that support that $215,000 without having to do calculations like, let's do add backs, let's add money because this property has a garage or this one doesn't. They're going to want to be able to clearly see that. And if they can't clearly see that, the hard money lender is going to say, you know what, we can still lend on the deal, but I can't lend you the $151,000 that you wanted. I'll lend you $130,000 and you're gonna have to come up with $21,000. It's a heck of a lot less than coming up with $71,000, right? But you're still having to come up with a big chunk of change. So the point here is, if you wanna get an asset-based loan, and you want to get your purchase, your rehab, your closing costs, and all those things, you have to get a really, really good deal. Now, if it can't cover all those things for the asset-based, does that mean it's a bad deal? No, it doesn't mean it's a bad deal. It might not be a great deal for you, but that doesn't mean that's a bad deal. We'll go over here where we got the person, and this is the traditional. Does that mean it's a bad deal? No, it means it still could be a profitable deal. It's just, it's gonna need some money to come up with, okay? So you're getting your purchase, you're getting your closing costs, you're getting your payments all covered, but you're $20,000 short for all of that. It was $151,000. The loan's for $131,000. Keep in mind, you bought the property for $100,000. You're getting a loan for $131,000. This was the purchase price. So this is the loan amount, and you're coming up with a $21,000 difference. Now, that doesn't mean it's a bad deal, because you could still be able to sell that property and make a profit, but you're going to have to come to the table with some money. So what a lot of people get confused on is, why is hard money or asset-based money a lot more expensive than what I see driving down the freeway and seeing a billboard for? Now you know the answer to that. The reason is, it's based upon the asset. It's not based upon the individual. So they're not getting mortgage insurance that's going to pay them if something goes wrong, not getting, making sure you've got your job or your income sources verified, or your debt to income ratio, so that they can make sure that you can make those payments, which includes the new payment they're going to be taking on. All of that is analyzed. They're analyzing more the person than they are the deal. So if you can check all those boxes, if you can have a house that doesn't need work, and you have the employment, and you have the income, and you have the money down, and you have all those things, then you can get a 6% loan, or whatever interest rates are going for at that time, with lower closing costs and lower origination fees. But if you need to get your purchase, your rehab, your closing costs, and your interest in those things, you're going to have to find a really, really good deal, because this is an asset-based loan, and all of those things are going to have to fit 75% or under the after repaired value of the property to get financed. If it can't fit under that, the difference is money that would have to be brought to the table by you, or there's other creative ways to come up with money to have that, have somebody else come up with that money for you, so that you can then make this deal actually happen. So asset-based loans, more expensive based upon the property. The property will be heavily critiqued. The individual, just want to make sure there's not bankruptcies, recent bankruptcies, foreclosures, collections, charge-offs that are recent, that type of stuff is what they're looking for. So it's just those main big things. Whereas if you came over here, if you had anything even close to that, traditional lenders would say, no way, we're not going to do it. So that's the difference in this spectrum. The closer you get to a traditional loan, the less money you're going to pay, and the less concerns are going to be on the property. We're still going to want to make sure the property value is out and those things, but we're going to be less concerned, because you have the ability to repay that loan. Even if something happens, you could make those monthly payments. Well, on the asset-based lending, we don't know if you can make the monthly payments or not, right? The way you're going to make the monthly payments is selling the asset, so that you can then pay us off, and we all walk away, hopefully making a profit, which is the goal. So that's the reason why we're dealing with those. Now, that brings me to another situation here. Just because a deal may not be good for you doesn't mean it's a bad deal. And this is the thing. If you need to get 100% financing on everything, okay? Your purchase, your rehab, 151, I think is what we're at. If you need 100% financing on all of that, you're going to have to find 75% of that, or what do we say, 210 or 215. You're going to have to get 75% of that, which means you're going to have to be buying a really, really good deal. Well, in the process of trying to find these really good deals, these really, really good deals, you're going to find some good deals. And those good deals may mean you need to come up with $5,000 or $10,000 or $15,000. These are still profitable deals. But if you don't have money you can come up with, and you get one of these deals, you're going to want to wholesale or retail. You're going to want to give this property to somebody else that has the $15,000 or the $10,000, and they'll give you a few $1,000s as a wholesale fee for doing that. And we have members that have money that would love to get those properties that you couldn't do because you don't have the money to do that. So one thing you've got to make sure of, you don't want to get too attached to the property, because the property may be a good deal, but it might not be a good deal for you to actually do a fix and flip on, but it might be a good deal to wholesale and let somebody else do while you're waiting to get the deal that may fit all these criteria for you, okay? Then what happens is, if you do a few wholesales, then you may have some more money that you could actually put down. So when you find a deal that may not be a really, really, really good deal, you find a really good deal, you've got a little bit of money to put down rather than having to wholesale that. So this is how this system works based upon your personal situation. So what I want to make sure that you realize is, if you don't have money to put into the deal, you're going to have to find an even better deal, or you're going to have to wholesale that deal to another investor who will give you some money as a finder's fee of doing that, and then they will take it and put their money into it and finish the project up. Okay, so that's the one avenue of doing that. The other thing you can do is get that really, really good deal, but no, you're gonna have to have a lot of patience and it's gonna be highly scrutinized. You should be ready for that, okay? Lots of people joke that you have to do DNA tests and sign over your firstborn and prick your finger and all that type of stuff to get a traditional loan. And think about this, they're lending based upon the individual and they wanna make sure the property is in that great of condition as well. Those are the things that they're looking for. So if you need 100% of everything, you're going to want to make sure that you're finding a really, really good deal. And if you're finding good deals, you're going to want to pass those on to other people that can have the capital to make that deal happen, get paid a fee, and keep looking for new properties. Now, I want to talk a little bit about BRRRR. So there's a bunch of different investment strategies. Okay, so you've got wholesale, which is basically you put it under contract. Let's get this going. You put it under contract and then you sell the contract to somebody else for a fee. That's wholesaling. Okay, you've got fix and flip, which means you're buying the property, you're renovating, you are reselling, and then you're making a profit. Lots of times people are intimidated by renovations, and rightly so, and it's better off for them to wholesale deals until they can get more experience with the renovations before they do it, because they're only having to do one piece of the equation, and renovation is difficult. There's things that happen. There's things you didn't know could happen that happen. There's a lot that can go on there. Now, the next thing is what's called the BRRRR, which is basically a fix and hold. So you buy the property, you purchase the property, you renovate the property, you rent the property with your hard money lender's permission, and then you refinance the property. Now, to do this, to refinance this property, you are going to have good credit. You are going to have to make sure that you have good income. You are going to have to make sure that your debt to income and all those things. This is a traditional loan. This is not a hard money lender doing this. This is Bank of America, Wells Fargo, Chase, the credit union. What if you can't qualify for a traditional loan? Well, then you're going to have to come and be doing either fix and flips or doing fix and wholesales. So then you're saying, well, man, I really need to get 100% financing. I don't have enough money to come up with. Then I have to be looking for really, really good deals, right? I need the purchase, the rehab, the closing costs, the payments, all that type of stuff be 75% of the after repaired value of the property. And as I find deals that don't match that criteria that need some money down, I need to wholesale those. So somebody else that does have that money, I get some money in doing that, which builds up some of my cash. I can do more marketing, or I'm getting myself closer to having money where I can put some money into the deal when I find a good deal instead of a really, really good deal. So the idea with this asset-based lending is if the deal is really, really good, all those things can happen, but that only happens about 25% of the time. Okay, next, let's talk about some big mistakes I see a lot of newer investors doing. Okay, number one, they overvalue the property. This is a major problem, okay? We will show you how to not overvalue the property. We'll show you how to value comps. We'll show you where the comps are. We'll give you our software that you can do all that. Overvaluing properties is a big, big problem. Okay. The next thing that happens is they underestimate repair costs. They think, oh, we're going to get all this done for $25,000, and when really it's going to be closer to $50,000. So one of the things that we do is we have forms, we have agreements, we have project managers, and all those things are to help make sure that you get the right rehab amount. We don't want you overpaying, but we certainly don't want you underbidding what you think it's going to be, because that's going to be a problem. Once the loan closes, there's no additional money. All the money's based upon and contingent upon the value of that property. And so if you only got $25,000 and you run out of money, you can't call and say, I need more money. It doesn't work like that because the loan was based upon a loan to value based upon the resale, which means you're going to be the one coming with that money, or you're going to end up having to sign that property back over to the lender. Okay, so these are really big things, and these are things that people get themselves in trouble all the time, is underestimating the rehab cost and overvaluing the property. The next thing that we get into here, number 3, is going to be time to get well, let's just call it time, okay? And we're going to talk about rehab. We're going to talk about rehab time, and we're also going to talk about resale time, okay? When you're dealing with contractors, you need to make sure you have great contracts. You need to make sure that you have great project managers that are going to work with you to make sure the rehab schedule happens. What happens is we do what's called a scope of work. Our project manager is going to help put a scope of work together with you. And then there's a pricing meeting to go over prices on those things. And then after that, then you're getting into a timeline discussion as to when the work's actually going to be done, what work can be done at the same time and what work can't. That's called a Gantt chart. And so that's put together as well. So a lot of people underestimate the amount of time it's going to take to get rehab done. And that's something that our project managers can help you understand and determine as well. The other thing is, lots of people think the resale is going to happen a lot faster than it is going to. So one of the things that our software does, the Investor's Edge software, it really can let you know what's called days on market, or DOM, days on market. Days on market basically say how long was this property on the market before it went under contract or before that property sold. So if the days on market in that area is 110 days, and the rehab's going to take you 90 days, you're talking about a 200-day rehab, which is roughly, who knows math better than me? Let's just get my calculator so you guys can see. 200 days divided by, let's just call it 30. You're talking about 6.5 months, so you're going to be talking about 7 months. So you can know this. This number, these numbers, you don't have to guess at those numbers. You can actually use some calculations to determine what those numbers are. And that's really important because a lot of hard money lenders are going to do a shorter term loan, maybe 5 months, maybe 6 months, but that means there are going to be some monthly payments that are not included in that you may have to come up with. Or like what we like to do is actually extend the loan term a little longer, fund some more for the for the monthly payments, but that means you have to get a little bit even better deal because some of that money is being financed. So you're gonna have to find a little bit better deal or bring some cash to the table so that you can make that happen. All right, guys, next thing I want to talk about here is what is the likelihood that you're actually going to get 100% financing, meaning the purchase, the rehab, the closing costs, and the payments are all going to be under that 75% of the after repaired value? Well, I can tell you for the last 2 years that we were tracking this, and based upon the time of this video being recorded, you had a 25% chance of being able to get a deal, so 1 in 4, where it was actually the purchase, rehab, the closing costs would all be included in that. Okay, and I actually think that's high. I think it's going to be a little lower than that, depending upon marketplaces and conditions and those things. You also had with us a 25% chance of spending $500 or less that you're actually bringing to the table, which I would consider 100% financing, but you may not. Let me show you on the whiteboard here. So historically, 25% of the time, there's no money down. That's fantastic. Remember, we talked about really, really good deals. That's what that is. Then we've talked about what maybe are good deals. If you have to come up with some money, maybe good deals, maybe 500 to 2,000, right? That's going to be 59% of the time is going to be there, somewhere in that range. And then the rest of the time, you're somewhere between $2,000 and $10,000. But I will tell you, there are deals where you have to come up with more than $10,000. Like that just happens. And that doesn't mean it's a bad deal. It might mean it's a bad deal, but it also might just mean it's a good deal, but not a really, really, really good deal like you would need to make the 100% financing happen. With that, our average customer during this time period brought $12,630 to close. The median, if you throw out the outliers, brought $5,701 to close. Okay, so it gives you an idea there. And we know that 25% brought 0 to close. And we've got about another 25% that brought less than $500 to close as well. So it gives you an idea of finding those really good deals. Now, this is going to change based upon market conditions. How is it a buyer's market? Is it a seller's market? How easy or difficult is it to make a deal happen? It's going to be different based upon marketplaces and geography. All those things are going to come into account as we're talking about this 100% financing.